Good afternoon, everyone. Friday, the 8th of December. I'm here with Jamie Shepherd and Greg May. This is our monthly Soteria Planning live discussion. As you will have known from the last couple of months, Soteria goes live with a different guest who is an expert in a different field to try and help and educate people across Facebook, LinkedIn, and YouTube today, where we're streaming, in a different, very important subject. And very excited to say that this Friday, we'll be talking with Greg about equity release. First of all, Greg, how are you?
Yeah, good, thanks. Yeah, thanks for the invite. Appreciate the invite to come on, and delighted to help and answer any questions you got.
Yeah, no problem at all. Looking forward to getting stuck in. Sometimes my co-host is Claire. This time I've got Jamie, who's trying to grow his hair as long as Claire. How are you, Jamie?
Yeah, very well, thanks, Ian. Yeah, I am, but you know, it's just taken a while. It's I mean, I guess it's a little bit longer than yours and Greg, so I'll stop there, right?
Yeah, we'll probably not start on the hair conversation just now, but we can maybe get to that later on. Let's see how the combo flows. So, but first thing I wanted to kind of get to really, Greg, was one of the questions. We obviously get a couple of questions when we know who's coming on, but who is Greg May? What's your background, and why should people listen to this live chat?
My background is I've been in financial services since I was 16 years old, so very experienced in the financial services world. I started off just working in a bank in the days that in the days where you went in and you made the coffee and the tea for the manager in those days. So that's how you started off, and then you just basically worked your way through the various positions and up the ladder, if you like. And
I don't know if you could get away with that anymore, HR wise. I'm not sure if that's a thing.
Oh no, yes, it was. There was days where I was carrying 25 cups of coffee down the stairs. They definitely, health and safety would definitely have had a field day on it. Nowadays they would anyway. But so I started off in a bank and then worked my way up. I had 10 years at a high street bank, and then finished up arranging mortgages for people for that particular bank, and then decided that I wanted to become what was termed as an IFA in those days. So I was doing pensions and investments and mortgages for people at that stage. And then there was a change in the regulations, and I decided to then just become a mortgage broker. So at that point, I became a mortgage broker, and then joined a couple of estate agencies in the Berkshire area, and then ended up just working my way again up the ladder on those particular organisations. Started running the financial services for an estate agency, and looking after and managing a number of mortgage brokers, and then I decided to start up my own later life lending company. So that's where Sage Equity Release came in, and I started it and decided to, rather than managing people, I wanted to go back to seeing people face to face. So I started Sage Equity Release, and I wanted to specialise in the later life market rather than the traditional mortgage market. It's just I find it more of an interesting area to advise in. So that's that's a number of products, equity release being one of them, but primarily mortgage related. So so I've been in financial services since I was 16. So and I'm over 50 now. So that's a few years.
You don't look a day older than 49, Greg.
Very kind.
So Jamie, obviously both Avocado, Soteria, a lot of our other contacts pass business to Greg. We know he's obviously a great guy with lots of experience, as said there. You thought it would be a really good idea to kind of get him on the Soteria live chat and talk about things, but there's probably a lot of relatability with Soteria clients in some cases, and obviously Greg's clients as well. Where's the overlap sit for you, Jamie?
So, I mean, from my point of view, I think it's more around the understanding of equity release. What is it? How does it work? What are the myths? And I guess from clients that have got equity release, whether they're going through the process of putting it in place, whether they've already got it, have they got the correct planning in place? So has their planning been reflected since the equity release was put in place? So have they got their LPA documents in place? And why do they need them? Have they reviewed their will since putting an equity release in place? Not suggesting it's something that must be done, but of course, if you're taking money out of your home for whatever reason during lifetime, because of course, a lot of people associate equity release with people that want to take out the money because they need it to live. But what I see is people taking it out early for lots of reasons, to give it to their children to get on the property ladder, to see others enjoy it whilst they're alive. So I don't know what you're seeing, Greg, but that's my understanding.
Let's get stuck into that then. Sage Equity Release is obviously your company, Greg. It's the company that you're talking about with Later Life Lending. So in terms of the equity release part of it, or lifetime mortgages, I think there's some different terminology, isn't there? Let's talk about the different terminology and exactly what it is for people that are watching and listening.
Well, the predominant part of the market with equity release is a lifetime mortgage. And a lifetime mortgage makes up probably 96% of the market in equity release. So when you talk about equity release, predominantly it's lifetime mortgages, but there is another scheme called a home reversion plan. But a lifetime mortgage is in theory it is a mortgage, but the difference between this mortgage and a traditional mortgage is that you don't have to make a contractual monthly payment if you don't want to. There isn't any affordability rules around it, so you don't need an income, and there isn't an actual term on it either. So the trigger for once you've taken out the lifetime mortgage, the trigger to repay the debt is on first death or first entry into long-term care if it's a joint plan. So that in a real high level whistle top story of life, that's a lifetime mortgage. A home reversion plan is where you where you basically a home reversion plan provider will purchase in effect your property or a percentage of your property and give you a lump of money for it. But the issue with that obviously is that you don't actually own part or all of your property. You can live there for the rest of your life.
Interesting. Okay, so quite different in reality to a traditional mortgage in most senses, really. Although it is obviously finance going, in this case, into your pocket rather than for a property purchase. What would be the main sort of common reasons your clients get equity release or kind of liaise and conversate with you about getting equity release?
Lots of different reasons. Quite a lot of them have been to repay a traditional interest-only mortgage. So that's where they've taken out an interest-only loan with a lender, and they have come to the end of their term with that particular lender. The lender is then asking for the money back. They've done a 25 or a 30-year mortgage. At the end, they come to the end of that 25, 30-year mortgage. They've just been clearing the interest on it. The lender has said, "Can we have our money back now, please?" And they don't have the funds to repay it. So that's one where a lifetime mortgage can be done to actually repay that debt, to make sure that they don't have to sell the property, which obviously is always an option, selling the property. And that absolutely always needs to be considered before doing any type of equity release lifetime mortgage. Income is one that's being done a little bit at the moment, with obviously the challenges that everybody's got at the moment, releasing to help with income, to top up income. So again, that is relatively common. Gifting to children is quite a big one as well, helping them onto the property ladder, and gifting to children just to help them out, clear debts and things. Again, like an early inheritance, that's quite common. So those tend to be the ones. Property purchases coming into it as well more nowadays, because you can use these for purchasing properties, not just releasing it out of your current home. You can use it to buy a new main residence, and that's one thing to say, is that it has to be a main residence. So you can't do these for buy-to-lets or anything like that. Not at the moment, anyway.
That's a shame.
Is there something that you can't use equity release for?
Not really, as long as it's legal.
Could you use it for a holiday home?
Sorry, yeah.
Could you use it for a holiday home? I know it's not your main residence, not a buy to let, but you're not renting it out.
Yeah, you can use it to purchase a holiday home. That's not a problem.
So
you can release things like
that. Picking on a couple that have got a property, and that's their main estate, just the property, and the property's worth about £1.2 million. So we know there's an inheritance tax liability there. We know that their options are they could take out an insurance policy to cover that liability, or just plan to pay the liability. Is it above board legit to potentially look at taking money out of the house as a way of potential, like, so if they took, for example, £250,000 out of the house, and now their property to their estate was worth £950,000, is that above board?
Yeah, it is. It's it can be used. Excuse me. It can be used for inheritance tax planning. You just need to make sure. You just need to be a little bit careful with it, particularly now that the interest rates have increased. Last year there was quite a bit of use of it for inheritance tax planning, and you just need to make sure it's been done in conjunction with a wealth advisor to make sure that it's the right thing to be doing. So before doing that, if I know that there's inheritance tax planning, if the reason is inheritance tax planning, I'll make sure that they've sat down with a qualified wealth advisor to make sure that it is the correct course of action for them, and that there's not other alternatives, because particularly with the way that the interest rates have gone up, you need to make sure that the returns are going to be adequate to make it worth its while, even though you are potentially saving on inheritance tax. And what if the inheritance tax rules change in the future is also something to bear in mind, because you could do it today, and you can only do, when you're looking at financial products, you can only base it on the advice as of today, because nobody knows what's going to happen in the future. But if suddenly IHT rules change in the future, 3 or 4 years down the line, then it might have been something which maybe wasn't necessary. But who knows what's going to happen in the future, because change of governments and so on. People play around with tax rules all the time. So inheritance tax planning, yes, and I was doing quite a few in conjunction with wealth advisors when rates were a lot lower. Now that the rates have increased a bit, it has to be done with the right advice.
Okay.
Yeah, it makes sense. I think the trend of what's happening over the next even 5 years, statistically, there's a lot of reports showing that we will have more 65-year-olds in the UK as an age population than ever before since we've recorded statistics, and more 65-year-olds, or more people turning 65 than people turning 21 by 2030. So it's definitely a market that I think people should be more aware of, because it's more relevant to the population and the demographics that we sit in at the moment. One thing that I've been talking about a lot in property at the moment, and I have no expectations for it to happen, but we talk a lot about where the top of the market, the top of the property market at the moment is almost stuck, because there's a lot of older people in big family houses where the kids have left. It's too expensive for them to downsize. They don't want to look after a big 4-bed detached 5-bed house anymore. They don't want to cut the lawn anymore and look after the front. But it's so expensive for them to downsize that they just don't do it. And the younger families need those properties, which stop the whole market moving. And it seems like if the government really kind of looked at it from a logical point of view, they would bring something in place, maybe a stamp duty holiday for downsizers.
Yeah, absolutely. Yeah, I couldn't agree with you more.
It would be lovely to see it. We doubt it will ever happen.
Yeah.
How maybe could equity release help in that situation, do you think? Is there a place for that scenario? Someone that's got an 800 grand house in cash, they don't have hordes of money in their bank account to make a move, but they've got a lot of money tied up in equity, and they actually do want to downsize, and their family want them to downsize. They maybe want to get walking distance to the local shops rather than being in the village where it was great for the family, but the family's moved out. How can this potentially help that scenario? Because that's a really common scenario in the home counties at the moment.
Yeah, absolutely. If you can, again, like I said, you can use this for a purchase, for a property purchase. So if downsizing, whenever I'm talking to a client, downsizing is always on the agenda because it's an option, and it's an option that needs to be considered. But as you've already said, that I do wish that they would bring in some kind of concession on the stamp duty to say that, over a certain age or whatever, if you are downsizing, that they don't have to pay stamp duty, because I think that would encourage more people to downsize, and I think it would be a brilliant thing to bring in. But if going on the current rules, if they need some extra funds to make that move, to make it worth that move, or if they just want to release some money and do a combination of lifetime mortgage and downsizing at the same time, you can use this for property purchases. And quite a lot of the time I am doing these to help people purchase properties. That also comes into play where unfortunately there's more divorces happening in later life, as we all know, more separations. And so again, it can help where if the property is having to be split, it enables each party to then go on and purchase their own home again in their own right, but they need a little bit of help because there's not enough equity by splitting the property between them. So again, use the equity, top it up a little bit with a lifetime mortgage, and that enables them to then purchase their own property again. Just helps, it increases their buying power. And it's something that you can actually, if you want to, you can clear the interest on these loans as well to stop the interest rolling up, which is the traditional way of doing it, which we'll probably come on to at some point.
And Greg, I've got a question for you. So back when I first started in this industry, I would sometimes meet people and they would say, "Oh yeah, mum, dad took out this bloody equity release, blah, blah, blah." I think it definitely used to have a very negative vibe around it. Would you say things have got a little bit more positive around? I mean, everything that you just said around, if I was thinking around my parents, everyone wants their parents to be happy, right? What's the point of sitting in an £800,000 house that's not being used, that's not being heated, that's not being, like, you'd rather money be put to good use.
Yeah, it's unfortunately it still does have a bad reputation. It has improved, but it still does. You see it online, and people slate it online basically as a product because of the previous sort of experiences they've had on sort of the older style plans, which perhaps weren't, or not perhaps, they weren't as flexible as the current modern plans are. And unfortunately, because it's online, people tend to believe it as well, because obviously everything that's online is correct, as we all know. But it's important to understand that a lifetime mortgage and equity release, it's not, I don't just look at lifetime mortgages. I do other later life lending as well, but lifetime mortgages being one of the products, and the equity release does still have a poor reputation, unfortunately. But it's very, as with all financial products, it's a very personal product. So it could be, there's lots of blanket sort of, I see these comments sort of saying don't touch it with a barge pole and what have you, but it's a very personal product, as is any financial product that you buy. So for someone in particular, to not touch it with a barge pole could be the absolute correct advice for that individual in their personal circumstances. But for somebody else, it could be completely the wrong thing, and unfortunately, it could put people off inquiring because they see the bad press about it. The main thing is to actually look into it, get the proper advice, and make sure that it's tailored to your own financial circumstances. Because for me, I'll only do it for people if it's the correct advice anyway, as you would expect. And I would say that anyway, wouldn't I? But it has to be tailored to the individual. So I've done plenty of mortgages where it's worked out perfectly for people where they come to the end of their term, the lender was putting pressure on them, for example, to repay the debt, otherwise they were going to get repossessed. I do a lifetime mortgage for them. It enables them to stay in the home. They continue clearing the interest on the new lifetime mortgage, which you can do. So they're running it like their old style interest-only loan that they had with a traditional high street lender, but it enabled them to stay in the home. But the interest is not compounding. because they're clearing the interest basically on it, which is what you can do on the modern flexible plans. The plans in the past, some of them you weren't allowed to clear the interest on, so the interest did compound, and this is where it does run away with itself, particularly at the higher interest rates. So that's where you have to be a little bit careful to make sure that you're taking out the right level of plans dependent on the rates at the time and your personal circumstances.
So Greg, I've got a question. So obviously somebody looking for a mortgage, they can go to their bank, they can speak to a broker. What's the options for somebody who's looking for an equity release? Obviously they can speak to somebody like you, but would the bank be able to help them as well? Is that
some can. A couple of the building societies have links with companies to offer lifetime mortgages. Most don't, but some do. You're much better off speaking to a broker, going and searching your local area for the local experts in your area in this particular field, because they'll look at, as a traditional mortgage broker will, they'll look at the later life market for you and make sure that it's the right thing for you to be doing. But you can go to some banks and building societies, but most don't offer lifetime mortgages. Quite a lot of them now are doing what's called RIOs, which are retirement interest only mortgages. RIOs are something that I advise on as well. So I do a suite of later life products, not just equity release, and it's important to look at the whole suite of products, not just lifetime mortgages, because sometimes a lifetime mortgage isn't suitable, but a RIO might be. And a RIO, without sort of going off on a tangent, Jamie, so apologies if I am, but a RIO sits between a lifetime mortgage and a traditional mortgage, in as much as with a RIO you have to be able to afford a monthly payment, because there's a contractual monthly payment with a RIO, but the difference between the RIO and a traditional mortgage is there isn't an end date on it. Again, so the debt's repaid when you pass away, you go into long-term care, but you are having to make a contractual monthly repayment. Because you're having to make a contractual monthly repayment, you have to then pass affordability rules for them. So you have to have income, but more importantly, you have to have good pension income as well, which is where a lot of people fall down with RIOs. So quite a lot of people that I see RIOs for, they fail the affordability model because they haven't got good enough pensions. Classic client that a RIO works quite well for is those individuals in the sort of what I call the old style pension scheme, so the defined benefits pension scheme. So people like teachers, police officers, local authority workers, people that have got the old final salary schemes. They're the types of people that I tend to be able to fit on a RIO, and it's a good product. It needs to be considered, and it's something that, again, when I'm talking to people and finding out about their financial background, this is where I start to look at the various products that are available, so that we can make sure that the advice is tailored to those individuals. So sometimes it's not a lifetime mortgage, but it's a different type of later life loan that I arrange for people.
What does a RIO stand for?
Retirement interest only.
Okay. It says what it says on the tin, doesn't it?
Yeah.
That's what it says on the tin.
Yeah, absolutely.
Jamie, if someone was to get equity release or a RIO or later life lending of some sort, how would that fit into their estate planning, their will, LPAs, that aspect of it? What would be your advice for someone that does do that? Do they do one first, then the other? Does it change anything in terms of the will, etc.?
Yeah, absolutely can change things with regards to the will. Because if Mr. and Mrs. Smith are taking money out of their property to give to their youngest child to purchase a property, and Mr. and Mrs. Smith are parents that love all of their children equally, then they might want to reflect their will that basically says, well, little Johnny's already had a lump of money, so on their demise, the older two children or the other children get a little bit more. So it's definitely always worth a review. And obviously from an estate administration point of view, it's just understanding, well, when does that equity release get paid? How does it get paid? Well, it gets paid from selling the property, right, Greg? Now, there are certain types of equity release, and Greg would be able to explain a little bit more, where you can go into drawdown that where if there was no lasting power of attorney in place could cause problematic, just like with anything. So some lenders will, I guess, not necessarily insist, Greg, but basically strongly advise that you have an LPA in place.
Yeah, really strongly advise. Yeah, they won't insist on it, but certainly when I'm seeing clients, I strongly advise them to take out a lasting power of attorney and a will if they haven't done it. Yeah, it's really important, massively important. But the power of attorneys are important to put in place, as you say, for drawdown schemes. So a drawdown scheme is where, and I've done quite a lot of these this year. A fair bit last year, but more this year, just because of the way the market has changed, where it's become more appropriate to be doing a lot more drawdown schemes this year. In that they take out the client takes out a smaller sum of money up front, and then has a reserve that they can draw further funds from in the future. So that's what a drawdown scheme is. So in effect, you take, say, I don't know, 10, 15 grand out to start with to get the facility set up, and then you do, say, 80 or 100,000 as a reserve, which you can then access in the future. It's the reserve can be removed, so it's not guaranteed that it will stay there forever, because the lender can remove that reserve if they want to, but most don't. Sometimes they play around with the levels of the reserve if there's issues in the market with house prices and so on. Yeah, so they then take the reserve, but the problems with the reserves come in dependent on how the property is owned. So whether it's tenants in common or joint tenants, and there can be some issues if you've got a drawdown and one of you passes away, and in the will it's been left to not the joint owner. It's been left to family or kids or something, because at that point they can't then use the drawdown any further. And in fact, with tenants in common, most providers, not true with all providers, but with most providers, if the property is owned as tenants in common and they've got a drawdown scheme and one of them passes away, or one of them goes into long-term care, then that drawdown will stop, basically.
There seems like so many different options for people, and I think what's quite interesting about this conversation for people listening live or listening later on is that when you get to that point where you think the mortgage is no longer an option, or it's too expensive because officially you could only get a 2 or 3 year a fixed period of time on a mortgage or a payment option, there is so many different options for people that are sat in equity. And that's the key thing. I think a lot of the population are sat in big houses paid off. They're not necessarily wealthy people by definition of what's in their bank account, but from an equity point of view, most of their money is tied up in their home, and potentially they feel stuck, or potentially they want a different direction. They might just want to pull 100 grand of cash out of their house to really enjoy the retirement they've earned at that point. They might want to go and travel the world, or they might want to, like you say, treat their children to a deposit, and give 50 grand each to a child to go and get on the housing ladder, so that they can feel confident that their kids are looked after and protected with whatever may be around the corner, or a variety of other things. They might want to buy a racehorse, whatever it is. They might just want to spend the money they work very hard to have in their property, and they don't realize that these different options are available for them, a whole suite of options. And I think why myself and Jamie are so keen to promote your services is what we know is that it does have a reputation, like our industries do as well, but it comes down to the person that's giving the advice. And with you, I think we know our clients are going to be left with someone that's really going to look after their needs and not sell something that they don't require, which unfortunately in all three of our industries is something that does happen. So if people want to get in contact with you, Greg, what's the best way for them to reach out to you?
Well, they can either go on my website, sageequityrelease.co.uk, or just via you guys. So just contact via you guys, and then you can pass them through to me, and that can also beyond me. But yeah, I've got a website, and that's got it's something that you can contact me by. But the
sageequityrelease.co.uk, I think it's this one here. Jump on that and get in contact.
I mean, you've hit the nail on the head with regards to the different things, though, because with a lifetime mortgage, a lot of all the products are called all lifetime mortgages are called lifetime mortgages with the providers. But there are different terms and conditions sat behind different providers' products. So again, it's making sure that I always call them the what ifs when I'm with clients. You know, what if this happens? What if that happens? And making sure that you're aware of where you stand if you take out a lifetime mortgage in the future, because it's very much talking about the future with a lifetime mortgage, to make sure that it's not going to cause you an issue in the future. Things like, you know, are you getting benefits is a massive one. You know, just to make sure that it's not going to cause you an issue and cause you to stop your benefits coming in, if suddenly you get some money into your account. But things like you were saying, sort of about taking holidays, different lifetime mortgage providers allow you to leave your home unoccupied for different periods of time. So that, you know, whenever I'm looking for bless you, whenever we're looking for whenever we're releasing for holidays, for example, you know, you need to make sure that how long you're going to be going away for. You know, is this going to breach the terms and conditions? Because some lifetime mortgage providers will only let you leave the property empty for more than 30 days. For 30 days as a maximum. Some others are 3 months, 6 months, and so on. So again, it's fitting the right. It's this individual advice. It's tailoring the individual advice to that individual to make sure it's the right provider. So, you know, not all lifetime mortgages are the same.
Interesting. No, good point. And again, another reason to have a conversation with you. If someone's got a question, it's worth just reaching out, and no question is a silly question on this subject, because you just don't know what you don't know, do you? So no. Really appreciate your time. Thank you, Jamie. Good to see you. Hope the sneeze was okay. And if anyone does want to get in contact with Greg, like I say, this is the website. It's in the comments. You can click on the link. And it will be well worth a conversation with Greg, because he's got a lot of knowledge in the area and general mortgage conversations as well. So I think what's nice is that you can talk to Greg about mortgages, and you can talk to him about this in a whole spectrum of things, just because he understands both sides of the story. So that will always be of benefit to any client. So have a lovely weekend, everyone. Greg, Jamie, see you soon.
See you later, Greg. See you.